Welcome to the U.S. Family Office RealEstate.com podcast with your host, DJ Van Kuren. Each podcast is about real estate-related topics specifically for family offices. Now your host, DJ Van Kuren.
Welcome to U.S. Family Office RealEstate.com podcast. This is DJ, your moderator today. And today I'm excited to have Martin Kollmorgen from the Serenity Alternative Investments. And the topic that we're going to be talking about today, once again, is family offices and real estate. But we're going to talk about a specific type of investment within that real estate sector that we haven't talked about yet. And I think that is important. And that has to do with real estate investment trusts or REITs. Marty, thanks for being on the show today.
Thanks for having me, DJ. Happy to be here.
Great. Well, so tell me a little bit about your firm and what you guys do, and maybe how you came about, forming this your company.
Absolutely. So I started Serenity Alternatives about 2 years ago, and the firm really grew out of my background, which is kind of varied. So I started my career right out of school working at a little quantitative investment firm called Quantitative Services Group. And Serenity is really what we hang our head on as being a quantitative REIT investment firm. Right? So I started the small quantitative investment company. We really had a top-down view of the world, looking at stocks based on their underlying kind of data characteristics and trying to figure out which perform better or worse based on those. Really top-down view, really interesting way of looking at the world, but I always kind of wanted to be a stock picker. So in my next career move, I moved over kind of to the opposite end of the spectrum. I started doing really fundamental work. I went to Deutsche Bank. I worked in their asset management group on their REIT desk and really took a really bottoms-up fundamental perspective in that group. And we had a $7.5 billion book over the time I was there. So we really went deep into individual REITs, looking at their individual assets. So I had a little bit of this unique combination of views of the world, and that I started from a very top-down perspective, doing kind of pure quant work. I went to the other side of the spectrum, doing purely fundamental work. And Serenity was really born out of the idea that if you can merge those two perspectives together, it gives you kind of a unique view of how to pick REITs, essentially, and a bit of a differentiated way of looking at the real estate world by itself. And that's what we're really trying to accomplish with the firm. We've been doing it for about 2 years now.
All right. So, and you're already leading me to a bunch of questions, but let's dig down a little bit deeper here.
All right.
And explain to me really what is a REIT, and how does a REIT function?
Absolutely. So REIT stands for Real Estate Investment Trust. It's just a fancy way of saying that it's a company that owns commercial real estate, right? Most REITs tend to specialize based on property types. So, for instance, you have multifamily REITs that only own apartment buildings, mostly high-rise, high-quality type apartment buildings. You have office REITs that most of the time only own office buildings, right, which, again, are usually CBD, multi-story, multi-million square foot office buildings. You have warehouse REITs, they're healthcare REITs. So they're really real estate owners, and they do it on an institutional scale. The interesting thing about REITs is that they solve this problem of kind of capital commitment and liquidity that you often have in real estate, right? If you want access to a giant office building, as a regular guy, it's almost impossible to buy an office building, right? You need $50 million, you need $100 million. With a REIT, you can buy an office portfolio for whatever investment amount you want, right? Because they're publicly traded stocks. So I think that's the main distinction between regular real estate companies and REITs, is that since they're publicly traded stocks, you can go on your E-Trade account, type in ticker BXP, and buy a share of a big office company. They're publicly traded stocks, so they offer this liquidity, so you can buy and sell them whenever you want. And at the same time, you don't have to invest in huge dollar amounts.
Got it. So you're talking about public REITs. Now, there's also private REITs.
Absolutely.
As well, correct? All
Yes.
right. So
Yeah.
what's the difference in the private REIT and the public REIT?
So private REITs are more like traditional real estate funds in that since they're not publicly traded, they're not listed on the exchanges. You can't see their prices move every single day. There's much less liquidity in those products, right? So from an ownership perspective, they may not be terribly different, right? A private REIT may own a bunch of apartment buildings the same way a public REIT would. They may own a bunch of office buildings the same way a public REIT would. The difference is really in the pricing, right? And one thing we should probably mention about REITs that a lot of people know about the sector already is they're tax advantaged. So there's no difference between public and private REITs in that regard, and that they don't pay corporate taxes. It's really just about whether or not they trade on the public markets or not. The public REITs, the publicly traded REITs that we deal in, tend to be a little bit higher quality. There's certain advantages to being a public company. You oftentimes have a lower cost of capital. It gets you access to the unsecured debt market. So a lot of the most sophisticated guys opt for the public REIT route. As you know, cost of capital is extremely important in real estate investing. It's one of the most important things. So it's a great way to lower your cost of capital, but at the same time, you have to have a certain amount of complexity to be a publicly traded REIT. It's a lot of work, right? You have to file quarterly statements. You have to go through the IPO process. You have to have a huge amount of transparency. So you need probably $2 billion in assets to be able to really have the bandwidth to put that much work in.
So when you're talking about the tax advantages, for a REIT, can you elaborate on that a little bit for me?
Yeah, absolutely. So REITs don't pay corporate taxes. It might make sense to take a step back and just talk about the history real quick. So basically,
Sure.
there was an act passed in Congress, I think 1962, called the cigar excise something tax, right? And it it was a big, long bill, and in the end of it, they put in the REIT Act, which was a small kind of line item in the thing, but basically created these entities, what the government was trying to accomplish when they did accomplish is they were kind of making a deal between large real estate owners and the public, right? These guys had mostly been off limits to small investors for a long time, and they said, listen, if you guys will list your shares on the public exchanges so that mom and pop investors can invest in you, we'll give you a tax break. So if you qualify as a REIT, you don't have to pay corporate taxes. All right, so that's a huge windfall for these guys. It's a big advantage over being a privately run real estate company, is that tax bill. What they said in exchange for that is that you need to pay out 90% of your taxable income as a dividend. So again, as a retail investor or as a smaller investor, now you can invest in these large real estate companies that have really institutional quality properties that they own. They don't pay taxes, so that's good for the investor as well, and you get a guaranteed dividend that's going to be paid out by these guys. So that's why REITs were created. Obviously, there's more rules that go with becoming a REIT now than there were when it was originally passed, but the benefits are the same, and that it's kind of a trade-off between those companies. It's really, it kind of makes me chuckle because it was like, it was a small rider and a small bill, and it turned into this massive sector. I mean, the REIT's a $1 trillion sector in just the public space right now, right? And Congress actually did something that was good for both parties involved, which by today's standards is kind of amazing.
Right. So now with the new tax law that's coming into effect, is that going to affect the REITs at all?
It does from an investor's perspective, right? So the REITs themselves haven't seen much change. It's very nominal changes in terms of how you expense things. But from an investor's perspective, the big change is that your dividends are no longer taxed at the ordinary income rate. So it's actually better as an investor. Your dividend bill is going to come down when investing in the REITs because they're essentially a pass-through entity.
Got it. Okay. So, one of the things that I remember from when we had our last downturn, in the real estate cycle was that the one thing about REITs, and in fact, there was a big acquisition. I'm not sure if it was Equity Residential or if it was BlackRock
Equity
or whatnot, but I remember your Equity Office, yeah. So whereas they were able to, or a group was able to buy a REIT at a significant discount for its share price rather than the asset values. Because there's not necessarily, and correct me if I'm wrong, a direct correlation between the share price of a REIT and the actual value of the real estate. Would that be safe to say?
No, it's absolutely.
Or that it's always. Okay.
No, that's completely true.
Okay, so to me that tells me then that creates opportunity, right? When you can buy something at a greater discount than what the actual value is, but then couldn't that also be a negative?
Yes, absolutely. I think you hit the nail on the head. If you just think about that deal, so that was in 2006, I want to say. Blackstone bought equity office properties. It was a blockbuster deal in the space. And just like you said, the stock was trading at a material discount to what we call net asset value, or NAV, which is like the liquidation value of the real estate. So what they did is they bought all the assets in the public market. They bought all the stock, and then they started selling those in the private market. So it's essentially what you think of as like public to private arbitrage, right? And since the price of real estate were so much higher in the private market, Blackstone made a killing on all the assets that they were able to sell. Unfortunately, they didn't quite get them all out the door before the downturn happened, but they still made a ton of money flipping a lot of those deals. And just like you said, that premium discount, that difference between the stock price and the net asset value can be a great opportunity. But just as you said, it's if you're willing to deal with that volatility, right? That's kind of the two sides of the coin, is that REITs are more volatile than traditional real estate investments. That creates opportunity, but you have to be able to stomach it, right? So right now there's a lot of companies that are trading at pretty high discounts to their underlying asset value. And it's because people think rates are going up. They're kind of scared of the REIT space right now. For someone that's been in space for a long time, this looks like a really interesting opportunity, because there are guys in the private space saying, listen, if I can buy this company at a 30% discount to the value of its assets, I can even pay up 10% to where it is in the public market right now, still have a 20% gap, start selling those in the private market, just like Blackstone did in 2006. That's an intriguing opportunity set, right? So being able to systematically, that's one of the things we try and do at the firm, is systematically take advantage of those opportunities as they kind of arise.
Interesting. So in some ways, would you call that the arbitrage opportunity is obviously a positive, but would you consider that a drawback of a REIT or a public REIT per se as well? I mean, to me, it seems like that it could be I guess it depends when you're selling, right?
Yeah. So it goes to the volatility argument. And this is why the REITs being stocks phenomenon is very interesting, right? Because you think that would be kind of a layup, right? Buy these companies at a discount to their real estate value, and wait for them to go back to the real estate value, and that's great. Well, the problem is when the real estate value is deteriorating, you could buy something at a discount to its real estate value, and then either goes to a deeper discount to its real estate value, and you lose money that way, or the real estate value comes down to match the public market stock value, right? So it's not quite a layup. You have to have a framework for figuring out where those discounts are most likely to disappear. And again, it's not for the kind of weak of stomach. There is volatility in the space, so you have to be able to say, okay, this discount exists. Can I stomach the fact that it might exist for another 6 months before I think it's actually going to realize itself? And historically, you've been paid to make that trade. It's kind of like value investing in the general stock market, right? A lot of guys that are really good at value know that you're kind of buying what's called the value premium, which is you're buying pain, you're buying stocks that are out of favor. That's really hard. It sounds easy to do, but it's really difficult to do. The same thing holds, I think, in the REIT space.
All right. Well, okay, so this is going to drive me right into the questions, which I think are going to be very helpful for any family offices or family office professionals that may be listening to this, which is, how to evaluate various REITs. What I want to do first, Marty, though, is we're going to take a quick break, and then we're going to come back, and then let's dive into some of that analysis and how you identify those opportunities. So we'll be right back after this quick break.
Hi, this is Jim Freed, the host of Freed on Business on 880 AM The Biz in Miami, and you're listening to the U.S. Family Office RealEstate.com podcast. The podcast provides you real estate information designed specifically for family offices. Make sure you check out USFamilyOfficeRealEstate.com for educational information for family offices, including white papers, fact sheets, videos, and podcasts. You'll also find information on specific markets and assets, real estate cycles, tax-efficient real estate investing ideas, and much, much more. That's USFamilyOfficeRealEstate.com. Information for family offices by a family office.
All right, welcome back to USFamilyOfficeRealEstate.com. Today we are talking with Marty Kollmorgen with Serenity Alternative Investments, and the topic today that we're talking about is REITs. So, Marty, before the break, we were going into some of the benefits or disadvantages of REITs. Obviously, you've got liquidity, but then you've also have the issue that some of the share price could be less value than what the real assets are. And of course, that leads to some volatility, et cetera. So, one of the biggest things is we've got a lot of very, very successful people that, listen to this podcast, but they might not necessarily have a background in the real estate area or really, I guess, REIT specifically, because that's one segment of the real estate market. So how do you guys go about evaluating a REIT? I mean, what are the things that you look for? How do you identify what you guys are going to buy, and what is part of that whole process?
Yeah, that's a great question. I could spend 2 hours on this topic if I need to, I think, DJ. Let me start a little bit different probably than you would expect. I think it's valuable to talk about really quick what not to do first, because there's a couple traps that people fall into really quickly in the REIT space, and I think turning those over helps immensely from the get-go, and then I'll get into a little bit of what we look for when we actually try and be a little more opportunistic in the space. One of the things that I see a lot that people start with in the REIT space is dividend yield, which is a great way to get yourself in trouble really quick, unfortunately. So if you're actively looking to buy companies with high dividend yields, you historically do not perform as well as the benchmark. And the reason for that is a lot of times those high dividend yield companies tend to be in slower growing real estate property types. So the higher the dividend yield, the almost more bond-like the company is. So you can find a REIT that pays a 7% dividend yield, and that sounds great, but it never grows. It's probably got 10, 15-year leases. There's probably very little rental growth in that property type. And those work in certain markets, and you can do well in those names, but over the cycle, they don't tend to perform as well. What you really want to look for is something that pays more of a 3 or 4% dividend yield and has 3 or 4% growth. So while your yield, the return that you're getting from that yield is less, you're actually making up for it on the capital gains side, right? So if this company is growing its NOI, say it has shorter-term leases, it's raising rents actively, maybe it's developing or buying properties, you can get to a 3 or 4% yield, you can get 3 or 4% growth on top of that, you get to an 8, 9, you can get to 10% growth in some of these companies, and you're a lot better off investing in those type of companies that are actually growing their real estate value as opposed to companies just paying a high yield. And that gets to really the main criteria for buying REITs, of what has traditionally performed the best in the space, is really real estate value growth, NAV growth. That is what I would say almost all REIT investors, however they approach the space, are trying to get to. That's what we try to triangulate for. We do it in a little bit of a different way than most guys do. Most guys really take a fundamental view of the real estate itself, so they'll go and look at the properties, they'll talk to the management team, they'll do really in-depth due diligence into the property type, We tend to take more of a top-down perspective and say, okay, if this company is really growing their real estate, then their net operating income should be growing at this rate. Their EBITDA should be growing at this rate. There's a data series called Consensus NAV, which you can actually just look at the growth in that number. So that's really what you're looking for in the space. When you're starting to evaluate companies, it helps to kind of start at the sector level to really get comfortable with what types of properties these companies own, right? So if you think that the office market is due for a rebound, start with the office companies. Listen to the conference calls, try to get a feel for the management teams, look at the geographic distribution of their portfolios. These are great first steps into the space. Once you start to get deeper, again, you really want to try and find companies that are growing the value of their real estate the fastest. Those companies tend to outperform over time. And that, again, can be in the form of net operating income growth, NOI growth. It can be in the form of this consensus NAV growth. You can look at earnings growth. It's not quite as good. Dividend growth is actually a great metric for gauging out performers. So it's an interesting kind of barbell to that. Okay, don't look at dividend yield because that can get you into trouble. But if you can find dividend growth series, if you can find dividend companies that are growing their dividend faster than others, that's actually a pretty good predictor of performance within the REIT space.
Interesting. So, the fund that you guys have that you started a couple years ago is more of a fund of funds, right? So you're investing into multiple REITs, is that right?
We are. We assemble baskets of REITs for our clients, essentially, DJ. So I think of our offering as a high-quality, diversified real estate portfolio. I don't love the term fund of funds because then you think of a fund of hedge funds, which is what we're definitely not.
Right.
I think of us as assembling really well-diversified, again, high-quality real estate portfolios. And that's really what you're able to do in the REIT space, right? And it's a traditional challenge in traditional real estate investing is that if you have the capital to buy commercial assets, if you're buying them one at a time, it's difficult or it takes a lot of legwork at least to assemble a really diversified portfolio, right? If you buy an apartment and then you buy an office and then you buy a warehouse, maybe you have one in each city, but you don't have great geographic diversification. The REITs offer all of that, any kind of diversification you can really imagine very easily, right? So you can assemble a 5 REIT portfolio of office, apartment, healthcare. You can throw in something a little more exotic like data centers or the cell towers, and really assemble a powerful real estate portfolio with very little work. So that's how I think about our business, is trying to assemble the best high-quality real estate portfolio that's liquid, it's diversified. We have an emphasis on quality and management quality, so we want to be investing with the best-run real estate companies, the best-run REITs as well. That's how we're thinking about assembling portfolios for our clients.
So are you actually meeting with some of the companies when you're doing your analysis? You'd mentioned about some people go out and look at the hard assets. I mean, what's your due diligence process consist of then internally?
So I don't do as much meeting with management teams as I have in the past. In my previous life, we had great access to management. I still have a ton of connections in that space. I have good friends in some of the C-suites of these companies, actually, which is fantastic. It is very informative to meet with those guys and to know them and to have a network in the space, because it gives you a great insight into who is really good at capital allocation, who is really interested in growing these companies for the long term. We capture that in what we call our management score, which is it's a model input that we have in the model. So that arises from both my knowledge of the space. I get a decent amount of help from friends that I have in space, colleagues, building that score. We also look at some purely quantitative factors. We have a corporate governance score that goes into that score as well. So kind of yes and no. I don't spend as much time with management teams as I have in the past, but I have a great base of knowledge in that space, and we still use those same kind of inputs in our model as a lot of guys do when they really spend a lot of time talking to management teams.
Got it. So, and how often do you make changes in your portfolio between one, with REITs?
That's a great question.
And when do you determine when you would be selling one of the REITs within the portfolio, or buying for that matter?
Gotcha. So one of the things that I mentioned at the outset, DJ, is that we are a quant REIT firm, right? And when I say quant, it's really gets at the heart of that question a little bit, and that we are fairly systematic in the way that we look at REITs. And that just means that we rebalance our portfolio on a monthly basis based on what the model tells us, and we don't fidget with it in the meantime, right? So the model runs, it constantly says, okay, here are the top 10% of REITs according to the model, and then at month end we'll say, okay, we're going to sell the ones that are no longer in the top of the list, and we're going to buy the ones that weren't in the top of the list last month but are this month. So we take a very systematic, disciplined approach to this. It's probably a little bit different than the traditional kind of portfolio management technique, which will be a little more ad hoc, which is to say, an analyst will go to a portfolio manager and say, hey, I made these changes in my model. I think we need to buy some of this company or sell some of this company. We're actually just strictly operating based on the rules of our model and rebalancing once a month, which is, again, an interesting thing you can do in REITs because they're liquid, much more difficult to do in the private market, right? Just from the perspective, if you were buying, selling buildings on a monthly basis, you would drive yourself nuts, right? You'd be drowning in paperwork. So it's a cool advantage you have in the REIT market that we can constantly be recycling into our best ideas.
Got it. So, on a global basis, about 18% of a family's assets are in real estate, and that's, stems everything from their own property that they have, their personal residence, into outside investments. In the U.S., that's come down a little bit over last year or so, which is about 10% of U.S. investors or family offices, invested into real estate. And, when I talk to people about their real estate investing, and I've had families ask me, well, what do you think about this? What do you think about that? I tell them that, look, you really need to have, if you're going to have an overall diversified portfolio within your whole, asset mix, let's say you do have 10% real estate, well, that real estate should be diversified as well. So maybe you have X percentage of that 10%, which is in hard assets, and, X percent of that 10% into, maybe a fund or, REITs, et cetera. So I think REITs are definitely, have a position within a family office's portfolio. When you're talking to some of your investors and families and whatnot, is there a certain way that you explain, or what are your thoughts about allocation toward REITs within that real estate portion of their portfolio?
I agree. They definitely have a place in portfolio, DJ. Speaking my language. No,
but I mean, when families, or when you're talking with investors, is there a certain allocation that you speak with them about as well? And where do you explain that, okay, well, this REIT portion should fit here within your portfolio?
Yeah, so I don't tend to give guys specific kind of percentage allocation ranges. I'm more trying to make the case that REITs are a great fit in almost any portfolio, right? They add diversification almost anywhere they're plugged in. So whether you have a large portion of your portfolio in private invested real estate, REITs are a great complement to that because of their liquidity, right? If all of a sudden you sour on the real estate market and when you want to take your exposure down, you can go to cash and REITs really quickly. If your portfolio is mostly weighted towards stocks and bonds and you want to introduce a real estate element, I think it's a great complement to those too. And that's, almost provable mathematically, right? Historically, if you add REITs to a stock and bond portfolio, your risk-adjusted returns almost unequivocally go up. Part of that's just the performance of the space. REITs have returned 11.5% on an annualized basis since 1990, which is 2% better than the S&P 500, and they've got a pretty low correlation with stocks, right? So they fit really well within most portfolios. They add a dimension to real estate allocations. They add a dimension to allocations without real estate. And I think they sometimes are penalized a little bit for that just because they're a great utility player. So they fit in a lot of different situations, but I think sometimes people have a hard time categorizing them because they're kind of bond-like, but they have this growth component, so they're kind of equity-like at the same time. They kind of sit in the middle. And while I view that as a positive and that they have kind of the best characteristics of both, some people just say, well, I can't really figure out where they fit. I'm going to throw them out. I think that's the wrong answer, but it is definitely tough to characterize them sometimes. I think they add a lot to a portfolio, like I said, regardless of if you own a lot of real estate in a private fund or if you own no real estate. It's just a great uncorrelated asset class.
Well, the one thing, too, is that what you do have with public REITs, which we've talked about throughout this, is the liquidity, right? You can actually get out, whereas if you have a hard asset, there's a whole process that you have to go through. And
exactly.
Not only to also along with the, I don't want to say headaches or, the maintenance and upkeep of a property, et cetera. So, between the professional management and the liquidity, I definitely think that it can be a good allocated portion of that real estate portion of the portfolio. And I'll tell you, too, is, a lot of people go out and pick their own REIT. I think there's something to be said by having a firm like yourself that's able to go out and still allow an investor to invest in REITs, but to have that professional management of identifying, okay, which REITs am I actually going to invest into? Because a lot does play into the factor. You've talked about a bunch of it already, and we haven't even gone into, market cycles or, what markets are these REITs allocated into? Are they B properties? Are they A properties? Are they, are they in thriving markets? I mean, there's a lot more that goes into it as well, right? So I think that the diversification that you guys can provide can definitely be a big benefit. So let me ask you, Marty, let's say somebody wants to explore this opportunity. How does somebody get in touch with you in order to, ask questions, gather more information?
Yeah, absolutely. I love talking about this space. I have a ton of information at my fingertips, so people are obviously feel free to reach out. Best way to get in touch with me is probably via email. I can pass that along. The email is mdkollmorgen@serenityalts.com, mdkollmorgen@serenityalts.com. I'm happy to talk about the space with anyone that wants to listen to me blab, to be honest with you, DJ. We've got a bunch of materials that we can help people with. It's great to go to the NAREIT website as well. NAREIT's the kind of governing body of the REIT space. They do a great job of making information about REITs accessible and really easy to understand. So NAREIT.com is their website. They're a great resource. But if you want to get a little bit more in depth, feel free to reach out to me. I love to talk about the space.
Yeah, and you bring up a good final point, is that, NAREIT, I don't think a lot of people are aware of NAREIT and the information that is available there, and that's just NAREIT.com, and I think that's a great resource as well. So today, thank you so much, Marty, for being here. We had Marty Kollmorgen with us today, and with Serenity, and we were actually talking about the REITs and the benefits of REITs inside a portfolio, and also about the importance of diversification and due diligence and everything else. And, I do suggest people that if you have questions, get in touch with Marty. He can be reached at 630-730-5745. He had given you the email before as well. And then you can also go to Serenity Alts. That's SERENITYALTS.com to find out more information. And Marty, thank you so much for being on the podcast today. This is a topic that we have not explored, we have not discussed, and I think it's extremely relevant, and this information was very helpful. So thank you very much for being with us today.
Thank you, DJ. This was a lot of fun. I really appreciate the opportunity.
Fantastic. So this is DJ Van Kuren with USFamilyOfficeRealEstate.com. Continue to check our website for white papers and other podcasts, videos, news. We've got a new website that's going to be coming out here pretty soon. And actually, we're also going to be launching the Family Office Real Estate magazine in the next couple months as well. So be on the lookout for that. But once again, thanks for being in our podcast today, Marty. This is DJ Van Kuren, and we hope that you tune in next time as well.